Hello and welcome to this edition of Money in Motion video blog. This is Dan Perkins and thanks for watching. Today I want to talk about two separate subjects. First, I want to talk about jobs and the importance of that for the coming campaign. And second, I want to talk about housing. So let's get started. You're going to see a series of charts that talk about the job report from last Friday. First, let me point out that the government reported that we created 38,000 new jobs in the United States. But they also told us, not quite as robustly as the 38,000 or the 4.7 decline to unemployment rate, but that the previous 2 months were revised downward 59,000 jobs. So the 59,000 that were revised downward took away the 38,000 that we created supposedly in the month of May. Now those numbers will be adjusted when the unemployment data comes out for June, which will be right after the 4th of July. The GDP, which was originally reported at 0.5% for the first quarter, at the second revision, which is done in May, there'll be one more revision in June, they revised it upward to 0.8%. So that so far in the term of the Obama administration, the gross domestic product has not averaged over 2% for a 12-month period. We can't grow this economy based on 2% GDP. We can't put people back to work on 2% GDP or less than 1. Now I realize that's a lot of numbers and you can look at the charts, but what's important is that I believe that the principal topic of discussion between the two candidates, whoever they turn out to be, whether it's Trump and Hillary or somebody else, needs to be on this campaign for president. What are we going to do about the jobs in this country? What are we going to do to get gross domestic product back up at not 2, 3, but approaching 3.5 to 4%? We get 3.5 to 4% growth in GDP. We're going to put a lot of people back to work. There's going to be a lot of money flowing into the Treasury. We can cut back on support benefits and begin to work on paying down the debt. So jobs, in fact, is the key for the success of this economy going forward. Each candidate has to tell us what he or she wants to do to bring jobs back to America, put Americans back to work by the millions, tens of millions, to get this economy growing again. That will be the principal subject matter, or should be, I should say, should be the principal subject matter for the debates and the campaign. Will be? Don't know. So far, it doesn't seem to be. They seem to be throwing barbs at each other on personal attacks. But eventually, hopefully, we'll get to the issue of what are they going to do to stimulate job growth in the United States. Now, the second thing I want to talk about is housing. This I have to give credit to two of my female clients who stimulated the thought to make this story. You're about to see some charts that talks about what has happened to the average price of housing in the United States over the last 10 years. And what you will see is that after 10 years, by the chart, the price of a single-family home today, 3-bedroom, 2-bath, single-family home, is less than what it was 10 years ago. But more important is that inflation has been 15% for that same period of time. So the house needed to go up 15% just to stay current with inflation. So what I'm saying to you is that even though you don't get a statement each month for your house like you do with your brokerage account, which it goes up and down each month depending upon market fluctuations, prices of housing can fluctuate. And you'll see in this chart that the bottom was not the 2008, but actually 2012, where the bottom was really the bottom of the housing market in the United States. Will it continue to rise? Hard to say. Will this be the first generation that at retirement will sell their houses and will not make any money? It's possible that depending on how much debt you have on your house and what the selling price is. I have a friend in Sanibel who was in the real estate business for many, many years in Chicago, sold his real estate business and told me that based on the information that he got recently from the National Association of Realtors, Americans are overpricing the value of their homes by about 25%. The statistics show that houses are being sold at a price about 25% below the asking price in many areas of the country, some areas even more. So while you don't get a monthly statement on the value of your house, it does fluctuate from month to month and year to year. Now let's talk about the markets. The markets are trying to figure out where they want to go. The Fed in December raised interest rates and the market crashed. Now the Fed was telling us, well, we need to raise interest rates 2 to 3. And so the market had begun to price in at least a quarter of a point increase in the short-term interest rates prior to the jobs number. Now the jobs number comes in at 38,000. The chairman of the Federal Reserve, Janet Yellen, is saying to the world, well, we're going to kind of wait and see what happens, and maybe we'll do something in July or maybe something in September. But if we don't do anything in September, we probably won't do anything because after September, we're getting into the presidential election, and we don't want to have the Federal Reserve involved in any dispute about what's going on with the interest rate policy for political purposes. If the unemployment numbers come in early July for June, and the jobs are not within the targeted amount, I would expect to see interest rates continue to fall, and the Fed, and the likelihood of the Fed raising interest rates in 2016 completely off the table. I wrote a piece for The Surge where I talked about just because low interest rates are available doesn't mean that businesses are going to borrow. With an economy producing less than 1% gross domestic product, and with productivity declining, why would a corporation try and expand its business when there is no business to expand to? So low interest rates, this is where I think the Fed is flawed. Low interest rates are not going to stimulate expansion in the economy because they're not producing enough work. So I think we're in for some difficult times, continued volatility, as I said in my last blog. Markets will go up, markets will go down. The one thing that I think looks to be happening is the recovery in crude oil. Now, I don't think it's going back to $140 a barrel, and it may trade $60 to $70 from its current level around $50. But at $50 a barrel, it's doubled the bottom. And there are some analysts this morning who are saying they think it'd go 65 to 72. What's important at 65 to 72, if we get there, is that American energy becomes profitable to drill for and produce. I happened to have an opportunity on my radio show last week to speak to the chief economist of the American Petroleum Institute, and she gave me some startling information. She said that gas companies, meaning natural gas companies, are actually able to make money at these price levels for natural gas. And when I asked why, she said by the end of 2012, it would take 5 to 6 weeks to drill a well to bring in the shallow natural gas. Now, they're able to drill wells in 3 to 4 days at 8 to 10,000 feet and bring a much larger gas supply. So they're amortizing their cost over a much larger supply, meaning they're going to be more profitable. These technologies are already being applied in the shale oil marketplace, and I suspect if we get back to around $60 a barrel, you may begin to see the shale oil companies begin to recover. I have a question for Mr. Trump and Mrs. Clinton. If we are still importing 1 million barrels a day of crude oil from the Middle East, from OPEC, why are we shutting in wells in the United States? Why shouldn't the American people have the right to be energy independent and buy American oil rather than pay the money to ship it overseas to Saudi Arabia? That's a question that needs to be asked in this campaign. So I look for continued volatility. I expect interest rates to probably fall even lower, which means you're not going to get any return on your money in the bank or in cash or in government securities. And we're down to 167 on the 10-year. So the idea that we have to look at alternatives like preferred stocks and master limited partnerships and common stocks that pay good dividends and REITs, become even more important because cash flow will be king. I think there's a good possibility that the new president, whether it be Hillary Clinton or whoever from the Democratic Party, or Donald Trump, or whoever from the Republican Party, really looks at the possibility of a recession in 2017. You know, you used to say that the incumbent in the office did everything in their power to assure the re-election of their successor, so that the last year of the economy prior to the presidential election was supposedly supposed to be a robust year so that people had good feelings about what was going on. That's not going to happen this year. So volatility is going to continue. If you have questions, you have concerns, please feel free to give me a call or send me an email. This is Dan Perkins, and thanks for watching.